up my last Bitcoin trade, but I think everything's going to be okay. And I have some very exciting macro news for you, which I think paints a pretty good picture of where the markets are likely to head once we get over this weird negative sentiment that we've been in since we failed to break all-time highs twice in a row. Let's get into it. So Bitcoin currently trading at a price of $121,576. We were watching the markets last night. I was watching this in real time. And as I said on yesterday's video, this low was absolutely fundamental to what happened next. Prices came down to contest those lows, and we slammed straight through, liquidating a load of long positions. You can see this in the data from CoinGlass over the last 24 hours, $274 million worth of long liquidations. And as I said in yesterday's video, these lows were fundamental because a break of those lows essentially confirms a downtrend from the all-time high. So the high is in here, then we have a low, then we have a lower high, and now we have a lower low. We are in a downtrend. We identified last night that the area between these lows, okay, 120,600, and these lows at 119,300 was the highest risk area that we had for liquidations, okay? Liquidation risk was stacked between these two lows, and we also know that traders love placing stops beneath lows, and that is part of that liquidation risk, okay? If a load of traders place stop losses at the same place, and a load of those traders get stopped out of positions all at the same time, that equates to forced selling on the market, which means supply shocks the market and prices can overextend down further from fair value. Now, knowing all of this, we had long orders placed in the book to try and make the most of that situation. You can see here from my video yesterday, our first buy order of 0.1 Bitcoin was placed at $119,600. And if we move over to BTCC, where I like to trade futures, where I was trading futures last night, you could see that the lows came in at $119,643. That means we were not filled, okay? This is where I screwed it up. We were not filled by $43. So often this can be even more frustrating than getting a trade wrong, okay? Our thesis played out perfectly, right? We broke lows, we bounced, and we got a really nice move to the upside, but unfortunately those orders were not filled and we didn't get into the long positions. And the most important thing in situations like this is to not chase the trade. So you can see on the 15-minute time frame, this happened within two 15-minute candles, okay? So within 15 minutes, essentially, if you're looking at one down candle and one up candle. And the temptation is to just dive in once you see the bounce happening. Now, sometimes you can catch this if it's happening slowly. It sort of goes against the theory, right? The theory is we want to come down really fast, get filled, and then come up just as fast, like a ball being pushed underwater. You want it to explode upwards really quickly. So if you have the opportunity to get in after the bottom, you better be really, really quick. Because otherwise, if the trade is playing out as it was supposed to, i.e. coming up really fast, you shouldn't really be able to get in after the fact. And aside from all that, getting in later than you'd wanted to just makes the trade way more risky, okay? Getting into the position at the right place is one of the best forms of risk management. And unfortunately, at this time, as I say, we called it, right? This happened as we were expecting pretty much, but we were out by $43. So unfortunately, didn't get into that long position, and that's where I screwed up. I do think we're likely to keep cooling off from here. The next point of interest to the upside is going to be the highs from that initial move up, and that comes in at $122,000, essentially, give or take a couple of dollars. I'm probably not going to look to short that unless some new information comes to light. But as you can see right now on the liquidation map, let me just refresh that for you. But what I want to point out is in the immediate term, okay, we've got slightly more short leverage to the upside, slightly more short liquidation risk at prices just a little bit up from here, but on the sort of mid-scale, we're pretty balanced to both sides. And although there is more short leverage in the market right now, today, on the one-day time frame, these are pretty balanced, and there's still a lot of longs to be liquidated to the downside. So I think with current sentiment, okay, not super excited. We're at 54. That is neutral. With the shape of this chart, okay, I don't like to rely on technicals alone, but I do think most people are going to be looking at this and thinking, that's not a great place to get long, all right? Now, one scenario that we could see, if we were going to bottom out here, is a load of people see that and they jump in short, and then this short liquidation risk at prices immediately close to where we are right now increases, and then the play becomes more likely to liquidate those, and maybe we shoot up a little bit more. But I do think it's more likely that we come down. Now the points that I'm looking at to the downside are this new low, okay, 119,700, and you can see that corresponds with $320 million worth of long liquidation risk to the downside. The next level that I'm looking at is the same level that we were looking at last time, okay, 119,300. And once again, I'm still keeping the remainder of my longs in the book. Okay, we're focused around this area here, 118,000. If I zoom out, you can see the reason for that is it would essentially be a flip of former resistance to former support, and that is a play that I think is likely to be a place where we're going to bounce from if we come down quickly enough, and that is going to be perpetuated by the liquidations. So I've got orders in the book at 119,000 at 118,600. And there we are. So in the short term, I do think it's more likely we slip a little bit further from here. Of course, it's not looking like it's going to be terribly dramatic from where we are right now, but as we drift lower and we approach these lows, that becomes all the more likely. Now, on the macro front, I do still think that this is looking pretty exciting for the long term, and that there are certain things that have come to light which make me even more excited about getting long when I can. Not right now, but if we see some more favorable pricing. Now, take a look at this tweet here from Bull Theory. Okay, so this is talking about essentially the relationship between gold and Bitcoin markets. Take a look. Gold's total market value just crossed $27 trillion, adding nearly $6 trillion in a few months. When large traditional assets move like this, they pull liquidity out of other markets. Money is rotating out of risk assets like crypto. And that is because historically, when precious metals rally, it signals economic weakness ahead. Right now, stocks are at all-time highs, gold is at all-time highs, silver is at all-time highs. Bitcoin was at all-time highs, but it is lagging, and it's being theorized here that is by design. Okay, so when everyone panics, larger players accumulate quietly. That's what we've been talking about. Big institutions prefer to buy at these lower prices. It is within their interest to see prices come lower so that they can accumulate. Okay, it goes like this: short-term fear, right? Medium-term accumulation, long-term expansion. Since 2013, BTC has closed green in nearly every Q4 with average gains of 80+%. So yes, the dump looks ugly, but it is a setup, not a signal of weakness. Gold and silver are absorbing liquidity right now, but when the flow reverses, it'll pour back into crypto fast, violent, and euphoric. And you can actually see here, post by Ash Crypto, gold has just started to top out. So historically, that is the signal that liquidity is going to start flowing back into Bitcoin. Now, the second thing I want to point out to you is this article from Arthur Hayes, which he recently released. He is theorizing that the traditional 4-year Bitcoin cycle is dead. Past cycles were driven not by internal crypto events like Bitcoin halvings, as traditionally accepted, but rather by changes in global monetary conditions, particularly the price and supply of US dollars and Chinese yuan. Now, what came out yesterday? Well, we got notes, or the minutes from the Fed's meeting at the end of September. And the upshot of all of this is it is much more likely that we're going to continue cutting rates into the rest of this year. You can see FedWatch is now predicting a 94.6% chance of another 25 basis points rate cut at the next meeting. And this means investors are more likely to take their money, or they're incentivized to take their money out of yield-bearing assets and put that money into risk-on assets. This means that money can flow into the crypto markets, and it's more bullish long-term, okay? It means that there is more money coming into the markets. Lark Davis here talking about the same article that I just cited from Arthur Hayes, and he mentions that as well as the Fed cutting interest rates, Japan and China are easing as well. So this means globally there is just more liquidity set to come into the crypto market. Now, if you couple this with the fact that today Trump announced that an Israel-Hamas ceasefire deal was in the works, this paints a very good long-term macro picture for the markets. Of course, markets do not like uncertainty. Markets don't like wars. And although this is really early days, of course, for a peace deal there, that would be very bullish for markets if it was to be reached, particularly if that happens soon. So there we go. In summary, although I think we're likely to come down before we go up again, the macro environment is setting up to be very, very conducive for the market expanding. As always though, that's just what I'm looking at, just my opinion shared with you for entertainment purposes. Nothing I say should be considered financial advice, but thanks so much for watching. There's plenty more to come. Catch you in the next one. Bye.